Good evening. Thank you for everyone. Thanks to everyone to join. This is the third part and the final part of our Finfluence series. It's been an exciting week to mark the celebration of our 100 crores AUM that we've achieved in the last 15 months. Thanks to all of our users and partners for making that happen. Incredibly excited to present the third session, which is a chat on how capital and different forms of capital can be a true enabler for growth for new age business models today. And we have three most relevant people to talk about it. I don't think anyone needs introduction, but just to go around the table, Nitin from Paragon, Anand from Nexus, and Pranav from 314 are incredibly active venture capitalists. They each bring years of experience on not only the VC side, but they've been operators, they've been consultants, and have looked at businesses from various angles. I'm hoping that through this session, we can spend a lot more time understanding what is the value that capital like lease finance or inventory finance can bring to some of these businesses, especially when traditional finance opportunities are not as available. I think, on a lighter note, I think it's exciting for me to be asking the questions. I have just spent 3 months answering questions from VCs. It's always good to turn the tables once in a while. Yeah. Thank you, gentlemen, for joining. I'll kickstart by asking the question that is the context for this session. If you ask a CFO of a typical brick and mortar company, right, and you guys have invested and been part of some of those companies, they will tell you the 5 different ways they're raising capital, and equity and debt will probably not be part of them, right? They'll have different ways of financing different pieces of their business. But when we ask the same question to a founder or to a CFO of a young business, of an early stage business or a disruptive technology based business, we rarely get an answer like that, right? It is always, okay, we're planning our next equity round, right? That's the typical answer that we get. Is there there a knowledge gap? Is there something else that you would pinpoint to this as a problem? And Anand, maybe we can start with you on this one.
Yeah, so very rightly pointed out, Nikhil, and I think there are 3 aspects to it. One is knowledge gap, second is access gap, and third is the stage of the company when this becomes relevant. Stage and also the type of company also. Like, so for example, if you go to a typical SaaS company, I don't think they are as cash hungry or as capital hungry that they need it. But if you go to a B2B platform, so if you talk to Shavik in infra market, I think 90% of his time goes into working capital management and how to make, similarly goes into capex heavy businesses also. The first 2 points being like the access part is also like, thanks to you, multiple different innovative models are coming. But if a Series A or a Series B sort of a company goes to a bank or goes to a invoice discounting, there is a lot of data which is asked, which forget why it's startup, like startup in a tech sort of a nomenclature. SMBs, early in their journey sort of companies, they will also struggle to get those access to that type of capital. And the second factor also does hold, which you talked about, is that the knowledge gap is definitely there. So a CFO in an established company is probably a 40 years experienced person who has been doing this and has his syndicates, has his access, has his networks to tap into that. A founder of a startup is steadfast focused into getting PMF, building his team. 99% of his time is going into that. For him, it's okay. आने दो पैसा, 10% कम efficiency में आ रहा है, but I'll get this done, keep growing. Later at that stage, when that part of the factor become more important to me, then I'll probably put somebody in the team and take care. So I think broadly in these 3 reasons why you see a less penetration of alternate sources of capital over there. If it becomes easy, maybe the situation might change, is what we are seeing.
Understood. Nitin, let me ask you the same question, because you look at companies which are slightly more mature or in a later stage as compared to both Nexus and 314. Do you have a different perspective or a different challenge that you see with respect to companies?
No, I think you're right. I mean, to some extent, ours is a little more boring kind of a business compared to Nexus and what 314 looks at, right? So these are scaled businesses. Many of these businesses have even resisted taking equity capital, right? And in many cases, we are the first organized institutional investor as a private equity fund. And many of these products, as Anand said, were not available. There was no access to something like this before, and it's sort of a new book that you guys are writing to some extent. There are all kinds of challenges and innovations to overcome those challenges that you have to get through, even from regulatory point of view, RBI point of view, right? And those are challenges which will help you sort of grow and overcome these, and then you can become even more scalable as an industry, right? There are a few players today, but over time, I'm presuming that as there is more clarity and more education and access is given, that will spread over time. Uh, but overall, we've had opportunity to work with your team and some of the other similar type of players using innovative methods of raising money, and especially during COVID, right, where some of these companies where the access to capital from equity was not that great, um, and the idea was to raise money without sort of diluting further. In many cases, we needed shorter term money as well. So I think from that perspective, it's been a great experience from in terms of working with your company. Um, but my view is that this is something which will take time to get to mainstream, and hence the education and access will all penetrate deeper over time. Today, I think it's a early stages of evolution of this industry overall, but it seems quite exciting to connect the dots and connect the borrowers and connect the lenders, so to speak, who look for stable and good returns. And there are not that many options today, right? Uh, from fixed returns point of view, your fixed deposit returns are minute, and an investor has very limited options, either invest in public markets or VC or something like that, or keep it in the bank at 6% post-tax 4%, right? So there are very few options in that sense. So I'm presuming that this will rise up. But so far, it's been a good experience working with you guys, and a lot of our companies are becoming increasingly aware of these products because of the work we're doing with them.
Thanks for that, Nitin. And I what you said made me look back at our experience of the first time we took venture debt. Right, this was in my first company, and this was maybe 2015 when venture debt was just getting started. And um, despite coming from a banking background, I didn't understand venture debt. Right? I didn't get why we should take venture debt, and it took our VCs to explain the concept and what it meant for the business. Right. Pranav, I'll come to you because we actually work with a lot of 314 companies, thanks to the education that your team has done for them, right? Yash and Sonal, we work with a lot of them. I think 2 of the transactions are already complete, and we're hoping to do another one on Monday. How do you think about this? Clearly education is one gap that we've identified. How do you think about it with respect to portfolio management, and that what you may be already doing with some of your portfolio?
Yeah, great question, Nikhil. I think fundamentally what I've seen founders want is the least resistant, least friction part to scale, right? And that's why they want to grow as fast as possible. And I think both Anand and Nitin made an important point that startups haven't been mainstream until very recently. So the mainstream capital options that are available to large groups, corporates, large private companies, going IPO, so on, were never really available for startups, irrespective of size, irrespective of quality of the cap table. So a good example is when we were starting out, for example, at the start of the last decade, we knew all the banks, we met all of them. We spoke about what they would do for our companies. And an interesting story is they would say we would never lend to a startup, right? Because the startup, we need minimum 5-year track record, EBITDA positivity, blah, blah. So in that sense, we were completely taken away. So if that is out and the mainstream is not available to you as a founder, you're going to go with all the other options presented as quickly as possible, which is why venture debt and so on have become important. But increasingly now, if you fast forward a decade from then, we meet the same people in the same banks. Of course, their titles have changed. It's been 10 years, but now you can see an excitement in them when they say, this startup is now my client. This IPO candidate is now our partner. We have 1,000 crore deposit from this company that just raised $200 million. So in that sense, now the whole narrative of the mainstream has shifted towards being friendlier to startups. Therefore, today there are more options available, and today's founders are, of course, much better educated, have more access for sure compared to even 5 years back. But an important thing is, I think every type of capital has a role to play. And therefore, what a startup would use at the Series A stage will be hopefully different than the options they will use at Series D or E. What they would use to acquire a company when they are say $500 million is different from what they would use when they're at $5 billion, right? So I think different forms of capital have different roles to play. Our job is to make sure we make all of these forms available to our founders. And we're very delighted to see that the founders are making very informed decisions. We don't have to decide for them. We don't like doing that. We don't like crossing that line. So in that sense, today, if GRIP, for example, is getting more popular, it's because founders have realized that there's a role to play for this, especially in the early to mid stages. And you should not be surprised that I hope more and more of those kind of companies become warmer and warmer and faster to adopt.
Understood. That's good to hear. And one of the data points that maybe corroborates what you said is a lot of the companies that we lease to, apart from having private equity or venture debt, also have some form of debt capital. Venture capital also has some kind of debt capital. And one of the common perceptions that is changing is around being able to secure some kind of bank lines, right? Mm-hmm. Often it is still very heavily based on fixed deposits and getting a secured line against those deposits. But at least there's a little bit of a change in momentum from the banking sector. Exits and monetization are definitely helping creating the right buzz, but completely see where you're going with it. And we have to spend a lot of time educating. And as we get more options, more of the CredXs and et cetera of the world, I'm hoping there'll be more adoption generally of different ways of financing. Yeah. Pranav, maybe to take the next step on this question, right? As you think about not pushing founders in a direction, but as you think about advising them, do you think there is a right stage? You mentioned, different forms of capital should solve differently. Coming specifically to leasing, because that's what GRIP's main product is. Is there a right stage that you think is good, not only from the company's perspective, but also from our users' perspective?
Yeah, so that's a good question, and we have to be importantly, focusing on balancing out all your stakeholders, especially since your investors tend to be retail and so on. So I think broadly in this country, what we've seen is the strictest controls are on any products going to retail investors, right? And that's why you have to have very high governance, very high reporting, absolutely high scrutiny on your regulatory filings. And in that sense, a company coming in, making that entire pool of capital available and being that bridge in the middle is very valuable to companies that would like to access that form of capital. It's too much work for them to do it on their own. Right? Yeah. So I think there's an important problem being solved in the middle, and that's why I think models like GRIP will see a quick latch on with many interesting companies. But from an equity point of view, we're pure equity investors, right? We can't even do venture debt, even if we wanted to. We can't lend to our companies. We're not allowed to. And there's an interesting role I see that the lease financing option will play, especially in models that are familiar to the retail market. So regular investors, for example, understand why a Furlenco or why a Yulu or why a Rapido, you mentioned a few companies, why these companies would be on the market in a marketplace like yours. Why would they be available, right? Yeah. And I think the interesting thing about the culture of startups is that, just until recently, retail investors couldn't buy any part of the company's products they use every day. So Zomato's IPO is, it's been a phenomenal success because for the first time, it's an app all of us use. Now we own a part of the stock, right? The US has had this benefit for the last 15 years. Apple, Google, Facebook, Microsoft, of course, Snapchat, now Robinhood. You can buy Robinhood shares on Robinhood. It doesn't get more recursive than that. Yeah. So it's always been interesting to see retail access the products, the companies that make the products they like, and be a part of the story, right? And a model like yours gives that option today before a company has to worry about IPO and so on. And hopefully these companies understand and respect the fact that these are not just some investors they don't know, these are potentially their customers, their future adopters. And it's important to keep that level of trust and relationship at a certain level. So I think culturally, there's a formation happening here that you guys will be an interesting part of. I think culturally, of course, Nitin mentioned the need for yield is something all retail investors are chasing. That's not going away anytime soon. And of course, now startups are getting more mature. They understand that lease has a role to play. It's a different risk profile compared to equity. So I can't use this money for other uses and so on. So there's a discipline that's coming in. I think that's a good sign overall for a maturity in the ecosystem. And obviously, therefore, lower friction for the companies that need access to this kind of capital.
Yeah. A couple of interesting points that you brought on, and maybe I can add some metric from our platform to just tell you what we are seeing. We have lots of investors who have made 18 investments on the platform, right? And the reason for that is simply being able to participate in multiple companies that otherwise cannot be accessed from either an equity perspective or any other product for that matter. And the most important criteria for a person to choose a transaction is actually not returns. Okay? It's actually either diversification or because they're excited about the product and want to have it in their portfolio and be part of that growth story. In a lot of cases, we've actually been able to link back the companies giving some kind of non-monetary rewards to the people who participated in that transaction. For example, Blue Tokai gave discount coupons on coffee purchases. Fab Alley gave discount coupons on purchasing apparel from Fab Alley. We're trying to do something with Uber to get discount on rides. So I think that part of the story which you talked about is immensely powerful as a proposition for such investments. And that's sort of what we're seeing play out. I think on the mobility side, because again, that's a focus for us, and we spoke about a few names, we're seeing it being interesting from a stage perspective. And Nitin, if you're okay, I'll link it back to you because you again look at companies that are at a slightly more mature stage, but we are seeing companies which reach product market fit plus, right, being the right candidates for leasing, where it is no longer a question about taking equity risk on the product, but there's enough confidence there for scale, right? And that's where leasing makes sense. Is that something as a logic that you would agree with and our users should look for?
Yeah, so I think, look, this is an interesting model, right? And it's something which many of these, I think you've sort of touched on this, is hardware as a service kind of a model, which is increasingly getting popular, right? So, in fact, one of our portfolio companies, just to take an example, called Chai Point, they put these dispensers in offices, and you buy the dispenser as a company and put it in the offices, and then you sell them supplies, and with those supplies you get a monthly sort of recurring revenue from that kind of business, right? So the entire business model right now relies on the balance sheet or the equity capital, or significant part of it is equity capital, and there is opportunity. We have discussed this in the past. Some part of it is already moved to financing on the leasing side. But this is something which I can see is something which can grow significantly, right? Where a company doesn't need to own these assets or hardwares on their balance sheet, and make that hardware element more scalable with the leasing option. So it's something which we are already seeing in one of the companies, and I see this as a trend. And there's a journey as well, because to some extent you want to prove out the hardware, right? So that's one bottleneck I would bring up, where companies introducing new innovative hardwares first want to prove those hardwares in the market, make sure that what they're seeing in terms of the models, etc., work, and then introduce them to the leasing kind of options.
Absolutely.
Nikhil, I'll add one point to what Nitin was saying. Like,
Yeah.
and just stuck my mind. Like, and I'm sorry, I'm just jumping in over here. You know, like the mother of all this hardware as a service was something on which the entire this SaaS and entire this thing is now based on. That's AWS, right? That's cloud. Because when it started, everybody was sort of maintaining their servers, and it was just suboptimal. Like, why will you put capex on the servers? Why would you maintain them? Why would you scale and scale down? That was the biggest problem, and that's where the software could not keep up. And that's where you got infra as a service. And if you now extrapolate that infra as a service, you'll see that there are so many other infras which are being used by, which should have a common base and can be just moved around with different companies as the companies scale fast and scale down. And it also becomes very important for this high growth companies. I wouldn't even say tech companies, the high growth companies, because the unpredictability on the nature of the growth, how it's growing, how it's scaling down, how it's scaling up, that varies. And just as what has happened on the servers can surely happen on this on a theoretical basis. Now, obviously, there is a lot of execution challenge, multiple things changes, and there is a software layer. So it's much easier to take. You do not need to actually take the hardware to the premises over there versus here you have to give control. But generally, if you at a theoretical level extrapolate, I see that it has not proven earlier. Infrastructure as a service has remained, and then that can sort of extrapolate into multiple other facets. Sorry, I just wanted to make this point.
No, this was a question that I really wanted your perspective, because no one gets SaaS as well as Nexus gets SaaS, right? So I wanted your perspective on hardware as a service, as a model, and what you're maybe seeing on that side. I think it's interesting if you are also seeing that same trend play out. I won't name the companies, Anand, but we are looking at IoT companies who are providing hardware as a service for compressor technology, right? Air quality technology, drinking water technology, right? Water leakage. And I think they're very, very interesting examples, not only just in business models, but also opportunities for us where we can provide a disruptive form of financing or a different form of financing.
No, absolutely. And similarly, what you're talking about SaaS, like what is the biggest thing that's happening on SaaS right now? It's APIs. And what is the inherent thesis or theory on API? Whatever is not core to your business, you don't need to build it. Let somebody build the payment layer. Let Plate give the data layer. Let Twilio build the communication layer, because it's common across all the business, but it's not core to your business. So let somebody else build it and use it as a service. That's all what SaaS is about. Same can go to the CapEx world, where if it is not core to your business, like if you're in a hotel business, of course you create a hotel. You cannot just give it out to somebody else. But if you're a logistics business where you are trying to cover the pin codes, but you do not want to own the inherent asset, because your core asset you are building is the network and servicing the client and the distribution, not just the CapEx over there. Theoretically, obviously, that should not be owned, and that should be probably leased from somebody else. So that makes sense. And that's the analogy, if I can see, with the SaaS world, if you ask me.
Yeah, I'm sure you've heard me say this before, but I love giving this example that none of us will ever own servers in our offices and homes. We all consume AWS, but there's no reason for AWS to own the servers as well, right? It's a commodity that can be owned by someone else, the warehouse by someone else, the cooling station by someone else, right? And I see that there's a trend where that sort of mindset is coming in, and what you're mentioning, where anything that is not core is being used as a service rather than using as a good, right? And that change is happening with respect to consumption patterns. Perfect. And on this, one of the challenges we do face when we speak to some of these companies, right? What we've talked about is that there is an appetite for this. Their business models are headed in the direction where this makes sense, leasing makes sense. But when we speak to a lot of companies, there is almost a stigma to utilizing platforms like Grip to raising capital, right? Because it is perceived as being this retail platform. It is not a VC platform. How do you think about it? And if you were to look at your portfolio companies and someone coming and saying, I'm going to leverage Grip for this capital or some other platform for invoice discounting, what would be your reaction?
No, it's all good. I'll actually have a positive feeling about the founder that he's being smart about using his capital. So if it has been there, I don't know. I have not at least seen in our circles that happening, but this should definitely, as Pranav mentioned, that a lot of these things is evolving. This will change with time. I like, for example, if again taking the example of infra market, right? Like where working capital is the main part of a business. So we are using as many lines of credit in as many ways, as many smart ways as possible, and that's probably the biggest secret sauce of the company doing so well. So I don't see why this will this will be looked down upon. In infra market, we have access to credits, we have access to trade credit, we have access to multiple different lines of credit from there.
Yeah, we needed, I think it's changing since we had some of the larger unicorns participate on the platform. I think it's changing, but we do see it for a few companies. Maybe it's a matter of time and just being acceptable on the platform, but great to hear that, as a venture, because a lot of the stigma comes from what will my VC say, right? And great to hear that you feel differently about this. Pranav and Nitin, this is maybe the next question for both of you. As you think about markets outside, right, and you draw the parallel to what's happening in India in terms of these different financing options, any light you can throw on what's happened in terms of the startups raising capital there and how they've looked at these different options? Maybe Pranav, you can.
Outside India, you mean?
Outside India.
I think the fundamental difference, Nikhil, is the cost of capital is very low in the main big ecosystems that are outside of India, right? Singapore, the US. Startups benefit, I mean, everyone benefits by having cost of capital at 2, 3, 4%, whatever
Right.
it is, depending on your profile. The cost of capital in India, while it's reduced finally, thankfully, due to the actions of last year, it's still for corporates between 9 and 11%, give or take, right? And therefore, the yields that the retail expects today is higher because the bank deposit rate has gone down. So there's a mismatch there for the retail market. So long story short, I think outside markets have never had the problems India has had, Indian startups have had. Indian startups have become mainstream now, so there's finally more equity capital available. We are waiting to see that kind of transformation happen in the debt, on the debt side now, and all the other forms of capital. So it would be fantastic, for example, if we have a Silicon Valley bank style program in India, right? All the banks should study that carefully, and SVB has been a big beneficiary and, of course, a benefactor of the whole startup movement in the Bay Area. What Mars is doing in Singapore, for example, again, has been pretty revolutionary. They're allowing startups to list their bonds and so on, and that's become a favorable way for startups to continue growing out of Singapore for the entire region. Right? So I think India also now we're going to have listed bonds and so on. Of course, you're tracking that market, and I think overall the trend here is to have that evolution happen faster, to have cost of capital being more stable, to have long-term tax regimes. Obviously, taxation is a big part of the yield design for your investors. That to become more stable, and therefore I think India today is realizing it's going to be a large market. It's growing into it, and I am seeing that formalization is happening much faster today compared to even 5 years back. So overall, I don't think we should look outside too much and compare. I should say we should look inward. We're on the right track, make it happen faster, and certainly innovators like you will keep pushing the frontier further, and everyone benefits from that.
Understood. Nitin, would love to have you chime in.
No, I think I agree with what Pranav is saying. At this point, the problems that you're trying to solve for are unique for India, and your solution works really well for India market as well. Maybe there are some other markets like India, maybe in some of the other less developed countries where this can happen, where the cost of capital is still significantly high. But the problem you're solving is so unique to India. The opportunity to grow is so significant in India itself. And you have in some ways among the first movers advantage, right? So I think that's where the energy and focus should be for you as well.
Yeah, absolutely. And coming back to maybe one of the questions that we get very frequently asked on, which is somewhere connected to how the market will grow, is that a lot of companies will have different cycles, right? And at a certain point of time, they may outgrow the need for platforms such as ours, right? Or do you see the platforms being able to keep meeting the requirements of the companies, right? There are two options that could play out. Company X, which is growing in the early stage, has crossed Series A, Series B, is now looking, it doesn't have access to traditional finance, so looking for platforms like this. At some point of time, it is now mature. Do you see that more likely, and then them stopping using the platforms, or the platform moving to a stage where they continue to serve the company?
I can take that. So I think, look, we have three of the panelists on this panel. They all come from different types of investments, right? From seed to venture to somewhat private equity kind of investments that we do, and that to some extent is a life cycle of a company that you will see. In India now, no one wants to grow at a low rate, right? The expectation for growth, both in terms of how the founders think and how the investors think, nobody wants to grow at a slow rate. And the expectation of growth rate, if it's high, you will need capital to grow, as simple as that. No matter what scale you are at, if you are a large company, even if you reach 1,000 crore revenue, some of the companies we know are continuing to invest capital, continuing to need that to grow further. The needs have become much larger, right? So in that sense, you have to be relevant for some of those guys as well. But the need for capital in India will always grow, given the kind of aspirations and ambitions that have grown both in terms of the founders and the investor ecosystem. And the need may again be different. The use of capital may be very different, right? Today, A startup may need initial seed capital for buying inventory. Maybe later on you'll need capital for customer acquisition, right, or marketing. So there may be different needs, but with the ambitions of the new Indian founders, I just feel that no one's going to be happy if the companies aren't growing like they used to be 20, 30 years ago, right? Now the need is very, very high and very aggressive.
Understood. One of the questions that I'm not going to lose the opportunity to ask maybe, and would love to get an answer from all three of you. If you were to pick one financing challenge of your portfolio that is not getting addressed by the traditional space, what would it be?
Yeah, I can go first. I have a long list of complaints, but I think the most important one would be how the banks have hitherto not at all considered startups seriously. Look, Nikhil, very bluntly, the job of a bank is to profit from a spread. And if startups do their job like they have in India, they've innovated, they've delivered results, they've created fantastic wealth. And startups are not a new phenomenon. Some of our biggest success stories like Infosys and so on were all at one point startups, right? And obviously they went IPO faster, but there's been a very clear trend of Indian companies becoming large and growing in this country, and that entrepreneurship is a part of the culture, I would say. But banks have never really played a role. In fact, Mr. Murthy's got a famous story at Infosys that the only time he went outside of the public markets for money is when he went to a bank, and they were very disrespectful, and he decided he'd never raise debt again. Right? And Infosys still has zero debt on the balance sheet, in spite of having 3 lakh people and I think over 70 million square foot of campus space. So it's a ridiculous reality that our banks don't play a role in all this innovation. And I think banks have finally realized that it's almost national service for them to be a part of this economy. It's almost essential for their survival to win these customers early and win that loyalty, win that trust, because when they're unicorns and they have 1,000 crore deposit, that's valuable business you can't lose.
Yeah.
Right? And today banks all want to compete for that 1,000 crore deposit, but none of them have built the relationship from the seed round. So I think companies like yours are obviously going to set an example for banks in many ways.
I'm not sure how to take that one.
See, look, what are you doing? You're disrupting the bank. You're taking retail deposits essentially, right?
Yeah.
And you're giving that, and you're building that spread, and you're doing it better than the bank does.
Yeah.
So there are many things that companies like yours are going to innovate, that set new standards, that open minds, that push the frontiers. And our legacy financial institutions, either they have to keep up or they perish. All of them are today embarrassed with their wholesale banking books, right? You've seen the NPA crisis we went through. So there's a lot of reality here inside this financial system that finally is coming out, is getting cleaned up, and it's been a record year for, obviously you've seen the news for tax collection, for GST, for debts being repaid, for the whole rebalancing to happen. I think we're entering a very different type of decade for India now. And therefore, companies like you, I hope, continue innovating. I'm more excited for what you're going to be doing in 5 years from now than what you're doing today. Because if banks are doing what you're doing today in 5 years, and you have to be so far ahead, it's going to be very exciting. We'll all learn something new, maybe, hopefully. So that's how I would think about it. But a lot of complaints over the last 10 years, we've not done as much as we should have.
Sure. Understood. Anand, do you want to add?
Absolutely. I think Pranav covered the core of it. Like he just killed the heart of it, the heart of the question, because that's the problem that the banks, why such a large, like not only startups, like in every entrepreneur faces this challenge. Like, I have companies which are not startup, which are in manufacturing. I advise one of those companies. He is making a revenue of 2 crore a month, and still the banks is like, okay, I'll give you a credit line of 60 lakh. Why? No, like this sort of documents everything. And the challenge there is that and the challenge is that whatever they are underwriting on lacking indicators, right? That what was your ITR in 3 years? A company which is growing at 30% month on month. How are you going to assess that company based on what ITR was 3 years back? Like 3 years back, probably, if I take any of my companies, they were probably nothing. So definitely, and let alone just the capital for growth, the working capital. Like the company needs a working capital. How are you without the working capital? How will they work? Now I understand a bit of it that you have to be like if you have to be fiduciary responsibility is there that you do not lose the money on that. But frankly, you are I believe that the current, and I'm going to make a controversial statement like that, this current financial structure that we have, that has supported crony capitalism, and in a lot of way that has failed actually the entrepreneurs by putting the money into much riskier deposit because of their systems. So now if technology can actually go and make this transfer of money more transparent and more efficient, and that can then, in that way, I'm not saying that take so much risk that you put into a company and lose the money of the depositor. That's the last thing the financial infrastructure in India needs, because the trust layer will be lost, which is very quickly depleting also because of the last 2-3 years, what has happened in the banks and what has happened with a lot of this one. But the way to solve is not to shut out the growing companies, but the way to solve is to innovate like in any other sector, and then get technology and get more information flow to write to those sectors which can actually contribute to your margins more and NIMs more, rather than trying to do something which actually hurts you. So lot of requirement from the financial structure, financial this thing. Hope more innovations like happen. That's where fintech is one of the space we are very, very bullish in Nexus. And as Pranav mentioned, next decade you will see hopefully we'll see a sea of change. If we don't, then that's like a mammoth opportunity lost, and then I don't know how India will recover from that.
Yeah, understood. I do sometimes think that we should stop using the word startup. I think it's almost got a tinge to say that this is too early, it's too risky, and to say that Zomato or Byju's is a startup seems doesn't seem right? But anyway, that's maybe my perspective and my controversial statement of the day. But there has to be a change in perception more globally about how to think about these companies and the very different business models they have. Yeah. There are a couple of questions on the chat, and I just want to address them quickly before we move on. So Prince, I think Pranav answered your question largely, which was to say that if banks don't innovate, there will be a move of deposits into platforms like ours, and then hence directly investing into some of these companies, and that will start changing. So I do believe that Pranav addressed your question in terms of what that happens to the market share. Venkatesh Varalu has a question, Anand, and maybe you want to take it as you think about some of your SaaS portfolio companies, which is around funding subscriptions that are coming from a client for a SaaS company. Freshworks subscription from an Apple or a Samsung, Zoho subscription from their enterprise clients. And it is already happening, but maybe you want to throw some light on it from an India client perspective and what you're seeing from an India SaaS company perspective.
Yeah, no, it's a valid point, and there are models in US and there are models, early signs of models in India that we are seeing. So for example, a very interesting company called Pipe has come up a big way in US, which does that you have subscriptions because the subscriptions are kosher, and generally if you do the maths well on net NRR and what the churn rates are going to be, you can finance them well, and many people are taking up that financing. So these models will definitely come up, and they will take off. The question over there is that many times the SaaS companies, the margins, because like the marginal cost of making the next product is not there. So that's where while SaaS is so exciting, like the gross margins are of the level of 97% and all. So that's where the requirement of capital might not be that much. So if you look at like for example Postman, we just raised the seed round over there to set up the team, and next round was raised at a much higher valuation, and the cash was still on the bank. They did not need any cash. So that's a little different form of business, but there are many SaaS companies in the 2.5, 3 million, 2 to 10 million ARR where the revenue thing is there. They know that the revenue will be there, but they can use that subscription. And then Pipe is an interesting company you should check out. There are couple of companies in India that has come up in this space as well. I think Recker, BridgeUp, a bunch of them trying to solve for this.
Absolutely. And Venkatesh, to the last part of your question, this is definitely something very exciting for us at Grip. We have been looking at this space quite seriously for a while now. We think of it as software leasing. We've been doing hardware leasing. It's very easy for us to start thinking about software. In fact, if you look at our previous conversation of hardware as a service, you're already leasing the hardware and you're not leasing the software layer, right? So what we're thinking about is how do we bring those transactions and make them enabled for our investors, and definitely part of Grip's future pipeline of products watch this space for more, and hopefully we can bring something exciting to you. Okay. Gentlemen, we are at the end of the session. I've got one question from a very interesting, from someone who watches this space very closely. Would be unfair for me to take this question. So let me just do that. And Nitin, maybe I can request you to take this. The unavailability of data, right, of these startups, and Anand, you talked about it, because 3 years back there was nothing, right? So what you typically look for in terms of historical data to be able to make decisions about credit, etc., is lacking. And if the asset, which is often innovative, drones, electric bikes, innovative assets, IoT devices, if the asset falls out of favor, then the main security that you have in the case of a leasing transaction is sort of coming to an end. Right? And how do you think about that as a risk to the financing transaction? And how do you counter that kind of risk? I think that's Archit's question.
That's a great question, and I think that's fundamentally an issue that that has to be resolved at a fundamental level, right? And I did that when I touched on this when I talked about the example of Chai Point, right, where they have these hardware as a service kind of a offer where they would launch a product, and then once the product is launched and is successful, only then figure out the lease and all those kind of options. Otherwise, there is really no value to that hardware if, let's say, the design is wrong, if there is some motherboard that needs to be changed and it needs to be sort of made obsolete. So I think that's a real risk which companies like you have to assess as well when you're doing alternative investments into leasing, on what is the longevity of such hardwares, what is the chances of failure for these hardwares, and assess based on data of how many have run and how many have performed over a longish period of time, especially to cover the tenure of the loan as well. So I think it's a very important point that someone has brought up, and this is certainly the other side of the business where you have to factor in the risk as well. And many of these companies have that data, right? So they will know that the first 100 units is a sort of a dry run. You make sure you put it in friendly places where you can get good feedback, rather than put in places where they'll just ruin your reputation in some ways, right? So they will start off with customers they know will give them constructive feedback, and then they will build over it, right? Because the other option is quite capital intensive, where you immediately ask for 50,000 hardware devices and then immediately deploy, right? So companies need to be measured in this. Companies like you need to be measured in this, in defining that risk and pricing it appropriately.
Yeah, and maybe there are a few more questions that came as a result, Nitin, and if I could just maybe take this up in the context of how GRIP thinks about it, right, and provide some of that perspective. You're absolutely right that we need to. It's almost like a case-by-case situation, right? And it's a diligence exercise that needs to be conducted. I always maintain that there is no one buffer to protecting credit default, right? There is no one way that you can make sure that 100% is covered. It has to be as many layers of buffer you can create to protect investor capital, and that's the philosophy at GRIP. I think in the case of a new technology, and maybe we can think of electric vehicles, which is a new technology where people are still experimenting with the product itself. Not only do you have to look at a product which is being tested in the market and has proven enough customer feedback to say this is scalable, but you need to think about the company you're deploying with, their appetite to handle repair, maintenance, their ability to deal with coming back of the asset, as well as the speed at which the returns are made to the investor and the capital is recovered, right? And then you need to think about opportunities to redeploy the asset. So I think all of that together, and probably 10 other things, is what you need to consider into making an investment decision about alternative finance. And I think that's the only really way to think about it, right? I see a lot of the questions popping up as we talk about risk. Maybe just in the interest of time, I'm going to pick up one or two more, and then bring the session to a close. There's one question from Himanshu that we haven't touched at all in terms of cost of financing. I think that's an interesting question, and we'll take that as the last question. The cost of financing for any of these new platforms ranges between 14 to 18%, or is a delta to any other form of debt capital, right? Typically available from banks. As you think about that cost of financing coming into the P&L of your portfolio companies, is that a cost of capital that you're okay with? And how do you think about that when you advise your portfolio companies? Pranav, maybe you want to take this up?
Yeah, for sure. So on cost, Nikhil, I mean, to be blunt, lower the cost, the better, of course. That's the only reason banks are appealing, to be honest with you. Everything else, we have to see on top of the lowest cost of capital possible, which is the only reason why it's worth it. But all jokes aside, I think, like I mentioned before, because India has perennially been a high cost of capital environment, the cost of scaling up has been very extraordinarily high. Which is why there's so much demand for equity capital. Equity capital is, from our basic MBA courses, we all know is amongst the steepest cost of capital around. And the expectation of startups is to give you a 20 to 25% net IRR, which is pretty steep. So when retail investors look at all the options, and of course, equity and venture may be too risky for them to allocate to at a certain, unless they're beyond a certain scale of wealth. Yield products like this, where I don't have to let my deposits be stale at 4 or 5%, whatever SBI is giving me today, I can actually put it to good use. I can help a young company. I can encourage new ideas like Grips. I think that's a very promising, like we discussed, very promising combination, very promising product. Now, Grips' challenge, to be fair, and the whole industry's challenge, to be fair, is to now think about the founder's perspective and say, look, your cost of capital has to eventually make sense for your business. And I think as you see your clients mature, that conversation will start. It may have already started for you, right? And you'll have to innovate, like I said before, on how you will reduce your cost of capital so the overall balancing act can keep up with where the country's macros are trending. So I think that's a good balance. I don't have an answer for you in terms of cost. Banks are offering 7 to 9% today for the best companies. And our best companies only after they have 400-500 crores on the balance sheet of equity capital. So very much more than, it's basically secured lending, let's be honest. So not all companies will get there. And to get there is expensive and you need to scale. Therefore, companies are willing to pay more. So I think you start with that, and then how far ahead you go is a technocratic challenge. And that's why experts like you will be needed. So that's a quick way of summarizing it. I could go into specifics, but again, it gives away too much information. So I'd rather stay at this level.
Sure. No, thank you so much for that. And we'll wrap up the session with that. I think this has been an incredibly open, transparent conversation. And thank you for sharing your thoughts so directly with us. I think our model our business model, the model for financing is far from where it needs to be. Okay. The financing sector is far from where it needs to be to meet the needs of the startups, whether it's risk, it's cost of capital. I think, like all of you have mentioned, there is tremendous innovation that we need to do, traditional players need to do to make that happen. We are clearly entering a very different decade for India. It's sort of like an inflection point on a lot of things, including how consumers are behaving and adopting new assets and new services and goods. And I think it'll be very interesting to maybe sit down again after 5 years and have this conversation again, right? We may be in a very different world. But thanks to all three of you for making this happen. We really appreciate your time. And thanks to everyone who joined in. We will be posting this webinar up on our YouTube channel, and you can also have a copy of it from there. Thank you so much.